Coinbase goes up, Coinbase goes down. Either way, somebody promises to mail you a weekly check. FIAT advertises a 75% distribution yield by taking the short side of coin through options. CONY advertises 77% by taking the long side and selling away part of the upside. They are opposite bets wrapped in nearly identical income packaging, and both have lost about 90% of their net asset value since launch. Yet after counting the cash, one sits at a positive 80% simple result while the other remains negative 26%. Same stock, opposite direction, radically different autopsy. Today we find out whether either payout machine preserved the investor or merely kept returning pieces of the patient. FIAT is the Yield Max Short Coin Option Income Strategy ETF issued by Yield Max. It launched on July 9, 2024. Despite the name and the financials equity category, FIAT is not a conventional portfolio of bank stocks, and it does not simply own shares of Coinbase and collect dividends. It is an actively managed derivative income fund with no index. Its listed holdings are United States Treasury bills at 59%, First American Government Obligations Fund Class X, ticker FGXXX at 4%, United States Treasury notes at 0.88%, plus 2 call options and 3 put options. The fund rates for premium income. That Treasury-heavy list can fool a casual reader. The government paper and money market fund are mostly the collateral table. The real action occurs in the option contracts built around Coinbase stock, ticker COIN. FIAT uses those contracts to seek inverse exposure. In plain English, it is designed to benefit when coin falls rather than when coin rises. It then combines that short-oriented exposure with a synthetic covered put strategy. The written options collect premiums, and those premiums help fund the weekly distributions. Here is the bargain hiding inside that phrase. A plain short position can keep gaining as the target stock falls towards zero. FIAT sells option claims around its synthetic short exposure, so it receives cash now but caps some of the gains it might otherwise capture from a major coin collapse. If coin rises instead, the inverse side can lose, and premium is only a cushion against the damage. The manager can adjust the contracts, but active management does not turn direction risk into a magic trick. FIAT is essentially renting out part of the profitable side of a bearish Coinbase bet to create current cash flow. CONY is the Yield Max Coin Option Income Strategy ETF, also issued by Yield Max. It launched on August 14, 2023. It is another actively managed derivative income fund with no index, but its directional engine points the other way. Its listed holdings are United States Treasury notes at 27%, United States Treasury bills at 77%, cash offset at 1%, First American Government Obligations Fund Class X, ticker FGXXX at 0.93%, plus 3 call options. The fund rates for premium income. Again, the government securities are collateral, not the main economic story. CONY uses options to create synthetic exposure to coin that behaves more like a long position. It then runs a synthetic covered call strategy. The fund sells calls against that Coinbase-linked exposure, collects the option premium, and uses available cash from the strategy to support weekly distributions. If coin rises moderately, CONY may participate while collecting premium. If coin surges through the terms of the calls, the option buyer gets the claim on gains beyond the cap. If coin falls, the premium can soften the landing, but cannot guarantee a safe landing. So these are not two copies of the same trade. They share an issuer, a weekly schedule, collateral-based synthetic exposure, concentrated dependence on one volatile company, and the habit of exchanging possible future gains for cash today. But FIAT starts with a bearish posture and writes options around inverse exposure. CONY starts with a bullish posture and writes calls around long exposure. FIAT wants Coinbase weakness but limits the reward available from extreme weakness. CONY wants Coinbase strength but limits the reward available from extreme strength. One is a bear wearing an income vest, the other is a bull carrying a toll booth. That distinction matters because option premium is not an independent return source floating above the market. It is payment for accepting an obligation and reshaping the payoff. High volatility can make those premiums look rich precisely because the underlying ride is dangerous. The cash arriving in a shareholder account can come from successful trading, realized gains, premium, or capital that is no longer inside the fund. A distribution proves that cash moved. It does not by itself prove that wealth was created. The funds are close on stated cost but far apart in scale. FIAT has a 1% expense ratio and $35 million in assets under management. CONY has a 1% expense ratio and $330 million in assets. CONY is much larger while the fee difference is tiny. Size can matter for product durability and trading conditions, but assets under management are not a medical certificate. Plenty of money can enter a strategy whose per-share capital is deteriorating. The cleanest way to remember the matchup is this: FIAT sells a capped version of the Coinbase down trade. CONY sells a capped version of the Coinbase up trade. Both turn volatility into option premium, both distribute weekly, and both ask the investor to accept that the cash ceiling and the loss floor are not symmetrical. Now we can examine what those machines actually delivered. This is research and education only. It is not financial, investment, tax, or legal advice. It is not a recommendation to buy, sell, or hold FIAT, CONY, or any other security. ETFs can lose value, including ETFs that make frequent or extremely high distributions. Options, synthetic exposure, distribution policy, tax character, holdings, expenses, and risks can change. Verify the current prospectus, holdings, shareholder reports, distribution notices, and other official fund documents for each fund, and consult a qualified professional who understands your circumstances before making any decision. The billboard contest is nearly a tie. FIAT's headline distribution yield is 75%. CONY's is 77%. Both are genuinely extreme rates and both pay weekly. CONY is higher, but that narrow gap is not the useful story. At this altitude, asking which number is slightly taller is like debating which side of a volcano has the better view. The first question is whether the ground underneath either rate is stable. Payment frequency creates a powerful illusion of dependability. A weekly deposit can feel like wages because it arrives on a familiar rhythm. But the schedule says when cash leaves the portfolio, not how reliably the portfolio earned it. Neither fund promises that each future payment will match an earlier one. The option market changes, Coinbase moves, the manager changes contracts, and the amount of capital available to support dollars per share changes too. FIAT has paid $127.82 per share in cash distributions since launch. CONY has paid $337.70 per share. CONY's cumulative cash total is higher, but it also launched earlier and began from a different reference price. This is not a fair race if we merely stack the dollars and declare a champion. The totals show how much cash crossed the account boundary over each fund's own life. They do not tell us what remained on the other side. That last distinction is crucial with distribution rates this high. Option premium may contribute to a payment, but a fund can also distribute realized proceeds or return capital. Return of capital is not automatically fraud, failure, or even a current tax bill. Its tax treatment depends on the official reporting and the investor's situation. Economically, however, a holder must still ask whether the payment was supported by enough gains to preserve the productive base. If the account receives $1 while the fund's value falls by more than $1, the deposit notification is doing public relations for a loss. CONY wins the surface-level yield comparison, 77% rather than 75% with the same weekly cadence and the larger cumulative cash figure. FIAT is barely behind on the advertised rate and has also moved an extraordinary amount of cash. But neither deserves to be judged as a paycheck substitute from the yield line alone. These rates are outputs of volatile, concentrated option strategies, not coupons from a stable bond. The yield tells us the speed of the cash leaving. NAV tells us what happened to the vehicle carrying it. Net asset value is the per share value left inside the fund after market moves, option results, expenses, and distributions have passed through. On this measure, both charts look like emergency room admissions. FIAT began from a launch reference price of $202. Its latest NAV is $20.94, for a NAV return since inception of negative 90%. That means the bearish Coinbase income machine retained only a small fraction of its starting per share value. Weekly payments may have softened the experience for a holder, but they did not prevent the asset still sitting in the account from being devastated. CONY began from $197.58. Its latest NAV is $17.94, producing a NAV return since inception of negative 91%. The long-oriented machine lost slightly more on a percentage basis. FIAT therefore held up better, but only narrowly. Calling that a victory would be like awarding the less crushed soda can a structural engineering prize. The honest diagnosis is that both capital bases collapsed with CONY's decline marginally deeper. The absolute latest prices are not the comparison. FIAT's $20.94 is higher than CONY's $17.94, but each started from a different reference level. Direction and percentage change carry the meaning. Both ended with only a small fraction of the per share NAV they began with. That matters for future income because a smaller capital platform has fewer dollars available to deploy, absorb losses, and potentially generate distributions per share. The symmetry is especially striking because the strategies face opposite directions. One might expect a bearish and a bullish vehicle to protect each other across different Coinbase regimes. The supplied since launch records instead show that a directional call can be right for stretches while the wrapper still bleeds through distributions, capped gains, adverse moves, and path dependence. The data does not isolate how much each cause contributed, so we should not invent a precise decomposition. It does show that opposite positioning did not produce opposite NAV outcomes. Both arrived with catastrophic erosion. NAV alone is not the full shareholder result because these products are built to send cash out. Now we add those distributions back using the supplied simple distribution inclusive return. This is not a reinvested, tax-adjusted, personalized performance calculation. It is the channel's basic conservation of value test, cash received plus value remaining compared with the starting point. FIAT's simple distribution inclusive return since launch is negative 26%. The distributions reduced the severity of the negative 90% NAV path, but they did not make the holder whole under this measure. The economic result remained below the starting point. That is the central failure behind FIAT's autopsy. A spectacular stream of cash did not offset the destruction in the share base. CONY's simple distribution inclusive return is positive 80%. That is a radically different all-in result. Its NAV record is even worse than FIAT's, yet the much larger cumulative cash stream across its own longer life more than compensated in this simple calculation. CONY did not preserve the value inside each share, but the supplied evidence says it created substantial net value when the cash outside the share is counted. Head-to-head, positive 80% defeats negative 26% by any honest reading. This is also why stopping at the nearly identical NAV collapses would be incomplete. The remaining assets look similarly injured, the total economic records do not. CONY's distributed cash rescued the result and carried it well above the starting line. FIAT's cash functioned more like partial salvage from a wreck that remained underwater. Fairness requires two boundaries. CONY launched on August 14, 2023, while FIAT launched on July 9, 2024, so the measurement windows are not identical. They encountered different sequences of Coinbase moves, volatility, and option prices. And the simple method does not tell us what happened to a specific investor who bought later, reinvested, spent the cash, or owed taxes. Still, for the exact records supplied, CONY delivered the stronger all-in outcome by a wide margin. The paradox is brutal, almost the same capital erosion, but one cash stream overcompensated while the other did not. The final return tells us where each trip ended. Risk tells us how violent the trip became and whether the income stream was strengthening or failing as the journey continued. FIAT's maximum drawdown was negative 92%. CONY's was negative 94%. CONY suffered the deeper fall, although both were extreme. A holder relying on either fund for spending money could have watched nearly the entire marked value disappear from a prior peak. That is not bond-like income risk. It is concentrated single-stock direction risk, option risk, and distribution pressure packaged behind a weekly calendar. Now inspect the payout trend with the arithmetic pointed in the correct direction. FIAT's first four distribution average was $14.85 per share. Its latest four average is 30 cents. The latest average is 2% of the first average. The payout fell dramatically. The current sequence is not merely a little softer than the opening sequence, it is a tiny remnant of it. CONY's first four distribution average was $18.60 per share. Its latest four average is 26 cents, the latest average is 1% of the first average. CONY's payout also fell dramatically, and proportionally it retained even less of its initial average than FIAT. Direction discipline matters here, neither recent average rose. Both collapsed with CONY showing the weaker retention ratio. Those early per-share figures should not be interpreted as permanent earning power. Share price history, fund actions, changing option conditions, and the amount of capital represented by a share all affect comparisons over time. We are not supplied every event needed to reconstruct the entire payment history, but the provided first versus latest averages are decisive about direction. The weekly schedule remained. The size of the weekly economic experience did not. FIAT's specific danger is that a sustained Coinbase rally can punish the inverse exposure faster than collected premium can protect it. A sudden Coinbase collapse is the environment its direction is built to exploit, but its cap structure can surrender part of the very windfall a successful bearish call would otherwise provide. It can therefore be wrong painfully and right incompletely. That is a difficult machine to use as a durable income source. CONY's danger is the mirror image. A Coinbase decline hits its synthetic long exposure. A powerful rally can help, but written calls can hand away gains beyond their terms. The supplied positive all-in record proves that the strategy captured real value over its own life. It does not guarantee that the next volatility regime will be as productive, especially with a much smaller remaining NAV and a much smaller recent distribution average. There is also behavioral risk. Extreme headline yields and weekly deposits encourage investors to annualize a moment, treat variable payments as salary, and ignore losses that remain unrealized on the screen. FIAT demonstrates the worst version of that trap because even after distributions, the supplied all-in result is negative. CONY complicates the lesson. Its cash truly did overcome the NAV loss in the simple return. But a positive historical outcome does not make a negative 94% drawdown or a payout at 1% of its early average easy to fund a future budget around. On pure risk control, FIAT was slightly less destructive, a negative 92% maximum drawdown rather than negative 94% and 2% payout retention rather than 1%. Those are factual advantages, but they are not healthy readings. The contrast is between two severe risk records, not between danger and safety. The important distinction is that CONY's historical reward compensated for its risk on the supplied all-in measure, while FIAT's did not. FIAT's assigned verdict is cause of death, NAV erosion. That label is earned by the collision of the supplied facts. Its simple distribution inclusive return since launch is negative 26%. Its price and NAV alone are negative 90%, and its latest 4 distributions average only 2% of the first 4 average. The fund sent out a remarkable amount of cash, but the investor was left with less total economic value and a badly diminished recent payment. In this autopsy, much of the apparent income behaved like the holder's own capital coming back in installments. CONY's assigned verdict is on life support. That diagnosis must be blunt without becoming dishonest. Its simple distribution inclusive return since launch is positive 80%, which deserves real credit. The strategy produced enough distributed cash to overwhelm a negative 91% price and NAV result. But the latest 4 distributions average only 1% of the first 4 average, and the capital platform still standing is severely depleted. The patient created wealth over the supplied period, yet the 2 vital signs most relevant to sustaining the old experience, remaining NAV and recent payout size, are flashing red. The fresh head-to-head conclusion is not that bullish options beat bearish options forever. It is that path and extraction rate can matter more than the direction printed on the wrapper. FIAT's short exposure did not save it from capital destruction, and the cash it extracted failed to bridge the loss. CONY's long exposure endured comparable internal destruction, but its distributions were large enough to produce a strong, simple historical result. That earns a less severe verdict, not a clean bill of health. These are different tools, and suitability depends on the goal. A tactical researcher with a specific view on Coinbase direction may study one payoff shape differently from a retiree seeking dependable spending cash. Someone prioritizing a positive historical all-in record will see a meaningful distinction here. Someone prioritizing preservation of NAV, stable dollars per share, or tolerable drawdowns will see that neither record meets that description. No one should turn this verdict into a buy instruction. FIAT offers inverse Coinbase exposure with current income and capped potential gains. CONY offers long Coinbase exposure with current income and capped gains. Those jobs are different, but both require accepting concentrated volatility, variable distributions, active derivatives management, and the possibility that a high advertised rate accompanies a shrinking capital base. The final question is not which weekly check looks bigger. It is, what outcome must the whole position deliver and which failure mode can the plan survive? FIAT leaves this examination with cause of death, NAV erosion. CONY leaves on life support. Verify the current fund documents because the contract's holdings, distributions, tax character, and risks can change after this snapshot. This comparison is research and education only, not a recommendation to buy, sell, or hold either fund. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.